we're going to go over a very important document called the closing disclosure. At the top of the closing disclosure, you're going to see the date that the disclosure was issued, the closing date, and the disbursement date. And the reason why they show disbursement date is that on refinances, there's a 3-day waiting period before they can fund the loan if it's a primary residence. Also, there are some states that do what's called dry funding, which means when you sign your documents, you do not close the same day. The loan package goes back to the lender, they review documents, and then they fund the loan, usually within 24 to 48 hours. It also shows a settlement agent, file number, property address, sales price. Then in the middle, it shows the transaction information, who's the buyer, who's the seller, and who's the lender. And then on the right, it shows the loan information. What's the term? Is this a purchase or refinance? What type of loan product is it? The loan ID. Then you drop down into loan terms. The loan terms are the loan amount, the interest rate, the monthly principal and interest. And if you look to the right of it, it says, can this amount increase after closing? All of the answers are no on this transaction. The reason they do this is because there are some loans that have different features where the loan amount can change, or maybe the interest rate can change after a period of time. And that would mean that the principal and interest payment can change. So in this case, it looks like it's a fixed rate mortgage and none of these things can change. Now, on this example, it shows that there is a prepayment penalty on this loan. Honestly, I haven't seen prepayment penalties on loans in many, many years, but that doesn't mean that you won't end up with a loan that does have one. So in this case, it's saying that if there's a 2-year prepayment penalty and the buyer could pay up to $3,240 if they pay off the loan in the first 2 years. Balloon payment? No. Balloon payment just means that the loan is due and payable in a short period of time. So for example, let's say you do a 30-year loan with a 7-year balloon. At the end of the 7th year, you either have to refinance or you have to pay off the loan in full. That's what a balloon payment is. Next section is projected payments. They're just going to detail what the payments are: principal and interest, mortgage insurance, estimated escrow. In this transaction, it's showing that the mortgage insurance will drop off in the 8th year. So if you look to the right column, the mortgage insurance is missing and the monthly payment is lower. Not all loans have mortgage insurance, and not all loans have mortgage insurance that will drop off. This is a conventional loan in this example, which does show the mortgage insurance dropping off. If it doesn't drop off, then it will, in the right column, it will show that it continues on for the full 30 years. Then you drop down to the next box, estimated taxes, insurance, and assessments. Sometimes that number is higher than the number that you see above it in estimated escrow, which is confusing. Well, what happens is that HOA dues have to be disclosed as part of a monthly payment, but the lender will not escrow homeowner association dues. So you may have HOA dues, and that's going to add to your monthly cost of owning the home, but the HOA dues are not included in the escrow, and that is most likely the reason why the estimated escrow is $206 and the estimated taxes, insurance, and assessments is $356. Drop down to cost at closing. This is just a summary. They're basically saying your total closing cost, $97.12, and that's broken into 2 sections. $46.9405 is what it costs you to get your mortgage, and then taxes and insurance and escrow account prepaids are going to come out to $5,018. Right below that is the cash needed for closing. This is going to be closing cost and down payment. Page 2 is all the details of these numbers. Okay, so you'll notice on this page that we have letters A all the way down to J. We also have vertical columns, and the first column is going to detail what the fee is. The next column to the right is borrower paid at closing, which means it's part of your closing cost, and before closing, which means that you've already paid it. The next section is going to be seller paid. This shows what the seller's paying at closing and what the seller paid before closing. And then the last vertical column is going to be paid by others. Paid by others is typically when you get credit from either a real estate agent or maybe you're getting a credit from a lender. I'll give you an example. Maybe you say, hey, if you can give me a higher rate, can you give me some money toward closing costs? And if the lender is able to do that, then you will see some of the borrower paid at closing costs will be moved over to the paid by others column. And then there'll be a little L to indicate that the lender paid it. All right, so section A is the lender's fees. And if you watch the loan estimate video, then we've already gone through this. It's itemized all of the fees that the lender's charging. Section B are fees that the lender has to disclose to you of what the appraiser charged, what the flood was, what tax was, if there were any. So basically, these are services that the lender has to order. You cannot order them. Section C are services that you're allowed to shop for. So that could be the title insurance company, that could be the closing attorney. If you decided to do a survey or a pest inspection, all those items you're allowed to shop for. Those are in section C. So the way this closing disclosure works is they're going to take A, B, and C. They're going to add it all together, and they're going to put that in section D. So total loan cost is $46.94 and some change. That is all of the fees in A, B, and C. Loan cost subtotals. Then it shows before closing, they itemize that separately. Now you drop down to other costs. Section E, F, G, H, and L. These are not mortgage fees. Most of these are going to be taxes and insurance that you have to prepay, especially if you have an escrow account. The only thing that goes to the lender is section F, and that's going to be 3, prepaid interest. You're basically paying your mortgage payment from your closing date, which in this case is April 15th, through May 1st. All right, so let's go up to the top. E, taxes and government fees. The transfer tax was paid by the seller. You'll notice that the $950 is in the seller column. F is a prepaids, the prepaid interest to the lender. Homeowner's insurance premium, so 12 months to your insurance company. In this case, or this example, it's $1,209. And then the property taxes were 6 months, and that was collected at $631.80. Then you go down to G. This is for the escrow account. They're prepaying 2 months for property taxes and homeowner's insurance. Aggregate adjustment just means that the initial quote had to be adjusted. Like maybe the closing day was off by 1 day, or maybe the amount changed a little bit. That's what the aggregate adjustment is. H is anything other. Now, again, this has nothing to do with the lender. In this case, it looks like this buyer has HOA fees, a capital contribution fee, HOA processing fee, home inspection fee, home warranty fee, and then, of course, real estate commissions fall under that, but the real estate commissions are not paid by buyer. They're in the next section over under the seller paid column. So if you go to section L, this is the total of other costs, borrower paid. Other cost subtotals, so EFGH, again, drops down, and they're showing you what that is. And then J, if you add everything up together, that's how they came up with the 9712. Next page is a summary. And basically what you do is you take your loan estimate, the last one you received, and you want to compare it to this closing disclosure. It shows you the total closing cost from the loan estimate that you received last time to the final. But then it shows closing costs paid before closing. The final shows that you had paid for something. Go all the way down to down payment. Then you look at the deposit. And here's the difference. The loan estimate did not show that the seller was giving you a credit of $2,500, but the closing disclosure does show that. And then adjustments and other credits. It says see details in section K and L. So if you want to know what that $1,035.04 is, go down to K and go down to L. and it will tell you what it is. Now you go to the seller's transactions, and it breaks down the seller's transactions as well. This is to verify that the seller is honoring their promise that they made on your purchase agreement. Go down to the bottom and it calculates everything, and that tells you how they came up with that number that you need for cash to close. These are just disclosures. It's the same as a loan estimate. It lets you know if the loan is assumable, whether there's a prepayment penalty, how much the late payment will be, whether or not this loan has negative amortization, which basically means you may not have to make a payment, or you may pay less than what's due and the balance goes up. That's what negative amortization is. Whether or not your lender will accept partial payments. It also shows you whether or not you have an escrow account, how much it is, how much they're going to collect. And then in the future, down here in the bottom right, it just says that the taxes and insurance can change, which can impact your payment.